Dollar cost averaging versus timing the market. Which is the best investing strategy and which is more likely to have a higher return on investment over time? That's the question that I'm going to explore and hopefully answer today by examining some historical data from the S&P 500. So let's get right into it. I've created a spreadsheet here by downloading some of this data from Yahoo Finance on the SPY ETF, which is simply an S&P 500 tracking ETF. Now, what this shows here is the closing price of this ETF on the first trading day of every month in 2020. And so what I'm gonna do is I'm assuming that if I purchased one share of the SPY ETF on the first trading day of every month, what would the return on investment be over the course of a year? And then I'm gonna compare that to strategies for timing the market and see which would have the most likely chance of having the better return on investment. So as you can see here, if I purchase one share of the SPY ETF every month in 2020, I would have a total return on investment of 22.42%. And that's assuming that I purchased it on the first trading day of each month. So the total market value would be around $4,673 and the total book value would be around $3,800. And so what I've done is, going over to my next spreadsheet, which would be the timing the market strategy, is I've taken that $3,817 and I've assumed that if we had that much money to invest over the course of the year, there were two potential strategies, right? One is dollar cost averaging into the SPY ETF, i.e. buying one share every single month on the first trading day of the month. Or what if I had taken that entire amount of money and purchased as many shares as I could on one single day? And what I want to know is how many days over the course of 2020 would that strategy have beaten the ROI on dollar cost averaging? So basically, how many days over the course of 2020 would have yielded me a better return than 22.42% if I invested the whole amount on that one single day? And that's what this spreadsheet here is tracking. So I've got the trading data, the closing price of the SPY ETF for every single trading day in 2020. And this column here is showing the ROI. And so what I've done is I've just done a conditional formatting here so that it's going to show up green for every single day that if I invested my total capital on that day, then over the course of the year up until now, based on the current market price of SPY, that my total investment would be better than 24 or 22.42%, right? This little box here is the results, okay? And so this is just the current price of one share of this ETF. So there were 252 trading days in 2020. And the number of days that would have beat the dollar cost averaging strategy was 93. And so that means that 36.9 or 37% of the days in 2020 would have yielded a better ROI than simply buying in one share on the first trading day of each month. So, I mean, it's all right, but already you can see it's less likely to have a higher ROI than simply dollar cost averaging in. So you know that you're taking a greater risk if you try to time the market, if you try to take your total capital and invest it on one single day, trying to get a lower price than your dollar cost average price over the course of the whole year. But you don't want to take that additional risk for equal results, right? You basically want to make sure that you're going to get a better return than 22.42%, because if you're assuming that additional risk for nothing, you know, there's no point in doing it. So this column here, over under, is actually going to track on how many days would we have achieved better than 5% in excess of that 22.42%. So how many days would the return on investment have yielded at least 27.42% or higher, right? Because again, trying to time the market for a similar return on investment, it's not a good strategy. You're better off just dollar cost averaging. You want to make more than the dollar cost averaging. And so if we look at that, again, using the conditional formatting rules here, there's obviously fewer days over the course of the year that would have beat that mark. And so the number of days that would have beat the dollar cost averaging strategy by 5% or more in 2020 was 69, which is 27.38% of the days. And so when you're looking at that, you're thinking you have basically a 25% or 1 in 4 chance of beating the dollar cost average strategy if you just take your total capital and throw it all in on one single day. But then I was thinking 2020 was kind of a crazy year, right? With huge dips, especially last March, and then huge swings back up as the economy started to pick up the pace from the pandemic. And so I thought I would extend my research a little bit further and then look at 2019 to see if the results would be comparable. And so here we're looking at the 2019 sheet, and you can see that if you invested and bought one share of the SPY ETF on the first trading day of every month in 2019, the total ROI on that would currently be 35.66%. And then going over to this tab here, which is the timing the market tab, we'll see again that this is showing the number of days that beat the dollar cost average strategy in 2019 was 87. And the number of days that beat the dollar cost average strategy by 5% or greater was 35. So the percentages in 2019 are even lower, meaning that there was an even less likely chance that in 2019 you would have timed the market and beat the dollar cost average strategy in terms of the ROI. And so this basically confirms for me that over time, the dollar cost average strategy must be better. It has a higher likelihood of yielding a better return on investment, unless you get lucky, of course. Unless you choose one of the 25% days in 2020 or the 13% of days in 2019 that would have beat the dollar cost average strategy. But while dollar cost average strategy is obviously going to be the best in the long run, and you should probably just consider investing small bits every month so that you're buying more shares when the price is low, you're buying less shares when the price is higher, but you're still investing every month no matter what. But in addition to that, if you have some cash set aside when there's a significant crash or a big dip in the market, then that of course could be a better opportunity to pick up shares at a discount. But again, over time, it seems as if the dollar cost average strategy just has a higher likelihood of yielding a good return on investment. So I know that the principle of time in the market is better than timing the market has been around for a very long time, and I'm not providing anything groundbreaking here in terms of my conclusions, but I thought it would be interesting to showcase exactly why that's the case with these spreadsheets and with this historical data from the SPY ETF, which tracks the S&P 500. And so now you can put this more concrete example behind that abstract principle that you've probably heard time and time again. And that's all for today's video. Thanks so much for watching. If you want to see more content about wealth building, investing, personal finance, and entrepreneurship, please don't forget to subscribe to the channel, and I'll see you next time.